a safe mine is a productive mine, and we will never trade safety for tons. Quality mining is imperative across all our operations. I believe we are consistently getting this right, which is evident in excellent grade control and stable, predictable production. Underground recovered grades increased to 6.27 grams per ton, driven by a phenomenal performance at Mponeng and a solid performance at Moab Khotsong as well. Despite the impact of safety stoppages and inclement weather in the second half, we still met the upper end of our guidance. In line with plan, group production decreased by 5% to 46 tons, or 1.48 million ounces. Quality over volume is yielding results, and we mine smarter ounces and boost our resilience. All-in sustaining cost increases remain controlled and in line with guidance, rising 17% to 1.05 million rand a kilogram, or about $1,800 per ounce. This reflects lower planned production, mine inflation, higher sustaining capital, and royalties on stronger revenue. Because we're a rand cost producer, the stronger rand resulted in higher US dollar reported cost. Even so, our investment case in quality has moved us down the global cost curve. We have expanded group adjusted free cash flow margins eightfold over the past 4 years, whilst investing to sustain and grow high quality ounces. Harmony has maintained its predictable cash operating cost base. Over 90% of our operating costs are rand denominated. Total labor and electricity costs make up 72% of group costs. Wage inflation is predictable under our 5-year agreement, and power tariffs are regulated. Royalties contribute about 41,000 rand a kilogram to cash operating costs on the back of improved revenues and profitability. As a result, total cash operating costs increased by 9%, and that is as planned. On a per unit basis, costs rose by 15% given lower production, as discussed. Our planning cycle and disciplined procurement keep cost outcomes within parameters, supporting margin resilience. High-grade SA underground and surface operations generate significant free cash, with margins of 44% and 36% respectively. Hidden Valley continues to deliver with margins at an exceptional 48%. Our optimized SA underground assets mine for cash at lower but positive margin, helping fund our growth and enabling us to extend mine lives responsibly. This portfolio balance is the engine behind record cash flow generation. Our FY25 results reflect more than just numbers. They show our purpose in action. Sustainability is not an add-on, it's embedded in our planning, how we mine and how we grow. Independent ratings confirm this progress with our inclusion in the FTSE4Good index for the 8th consecutive year, the MSCI upgrading us to BB ahead of industry average. CDP scored us an A- for water stewardship, and we conform with the SBTI for our global climate goals. These achievements reinforce our commitment to responsible mining and long-term value creation. Operational excellence is how we turn plans into results. The goal remains simple: safe, profitable production. We have built a quality portfolio that is resilient by design. We have divided our operations into 4 distinct quadrants, each with its own plan, risk profile, and strategy. This ensures we deliver as guided and extract the absolute best from our assets. Together, these quadrants give us stability and the capacity to reinvest into even higher quality ounces. Mponeng once again delivered a phenomenal performance with an underground recovered grade of 11.27 grams per ton. FY25 production from our high-grade mines increased by 8% to 16.5 tons, while grade improved by 10% to 9.89 grams per ton. All-in sustaining costs increased by 9% to close to 860,000 rand a kilogram. These assets generated 8.8 billion rand in adjusted free cash flow at an excellent 35% margin. We are extending the life of these mines to around 20 years each with disciplined, high-return projects. Once these projects are complete, Moab Khotsong and Mponeng, both with recovered grades of around 9 grams per ton, will each produce 200,000 to 250,000 ounces annually at steady state. Important to note is that we expect a dip in production at Moab Khotsong from 6 tons to 4 tons between 2027 and 2031. This gap arose largely as the Zaaiplaas feasibility study was only completed after Harmony acquired the asset. At both Moab and Mponeng, we experienced challenges in securing contractors to assist with our projects. At Moab, we've successfully mobilized our internal teams to keep the project moving and maintain momentum. At Mponeng, after the liquidation of the contractor, it took some time to renegotiate the commercial terms to ensure long-term value and execution certainty. We have adjusted project sequencing to maintain progress and to minimize disruption. These actions are already yielding positive momentum. Further, we are progressing the very exciting 100 megawatt renewable solar plant at Moab Khotsong, which will reduce our reliability on Eskom and mitigate higher tariffs and energy inflation. Hidden Valley delivered another strong performance. In line with the plan, production remained steady at 5.1 tons at a recovered grade of 1.35 grams per ton. All-in sustaining costs increased by 7% to 868,000 rand a kilogram. Free cash flow margins remained exceptional at 48%, with 3.8 billion rand generated in adjusted free cash flow. CapEx remains focused on capitalized stripping, necessary fleet replacement, and tailing storage facility development to sustain production. FY26 priorities include life of mine extension studies beyond 2030 and the dewatering cyclone project to optimize TFS deposition. Our South African surface operations remain a quiet powerhouse of low risk and high margin cash. Despite the heavy rainfall, which reduced production by 13% to 7.9 tons, margins stayed solid at 36%. As a result, all-in sustaining costs increased higher than planned to 853,000 rand a kilogram. We invested 1.4 billion rand on the projects at Mineway Solutions, which include the Career Run TSF extension and the Mispa pump station to sustain and grow output. The Mineway Solutions extension project is largely complete and is delivering 100,000 ounces annually. We are improving flexibility and the mining mix at Mineway Solutions as well. As a reminder, we have a further over 5.7 million ounces in resources in Old Tailings Dam in the Free State alone. Our optimized underground portfolio produced 16.5 tons at 4.58 grams per ton. All-in sustaining costs increased by 26% to 1.4 million rand a kilogram due to lower volumes following necessary safety stoppages, while still delivering 2.3 billion rand in adjusted free cash flow. The role of these assets is clear: mine for cash, safely and predictably, with improved discipline and flexibility. The priority in FY26 is the Target 1 turnaround, which is now showing green shoots in terms of higher volumes and grades coming through. Our FY26 guidance reflects consistency and confidence in our planning. Our planning is, of course, aimed at ensuring that we have safe, sustainable operations, where safety and long-term viability are non-negotiable. Production guidance remains steady at 1.4 to 1.5 million ounces, a level at which we have shown that our ore bodies can deliver safely. Underground recovered grades stay strong at above 5.8 grams per ton, and all-in sustaining costs are planned to rise to between 1.15 and 1.22 million rand per kilogram, driven mainly by mining inflation and higher sustaining capital. Total capital rises to 12.95 billion rand, driven by fleet replacement at Hidden Valley Mine and advancing the projects Moab Khotsong, Mponeng, and Mineway Solutions as discussed. We expect to close the MAC Copper transaction in October, pending tomorrow's MAC Copper shareholder vote. Later this calendar year, a final investment decision on Eva Copper project is expected as well. These catalysts could positively affect our outlook, and we'll share any updates with our half-year results in late February. We have a visible, sequenced growth pathway to ensure a more sustainable, profitable business which delivers long-term value. While copper is a near-term catalyst and a structural hedge that enhances portfolio durability, gold remains at our core. Our growth plans remain balanced and affordable and designed not to strain the balance sheet or execution capacity. It is focused on value and transforming Harmony into a higher quality global gold and copper producer. Our portfolio is changing, not just in size, but importantly in quality. We remain a gold-first company, and gold continues to anchor our strategy. As optimized ounces taper, higher-grade gold and copper equivalents step in. Copper serves as a strategic lever. It's worth noting that, based on our current planning assumptions, every 100,000 tons of copper equates to around 400,000 ounces in gold equivalents. We are not aiming for a fixed copper-gold ratio in Harmony. Rather, capital goes where there is value. We base our decisions on solid fundamentals, economic value, and the strength of our reserves. As per our current plans, by FY35, we estimate that around 40% of production will be copper from Eva, Mac Copper, and Wafi-Golpu.